Hello. Good evening, APOS members and guests. I'm Christy Morse, the Executive Vice President of APOS. On behalf of your hardworking APOS Board of Directors, I want to thank you for joining this webinar tonight on COVID-19 and legislation, focus on employment, benefits, and financial assistance. We've put together a stellar panel of experts to provide an overview about running your business during this difficult time, and also to discuss the Coronavirus Aid, Relief, and Economic Security Act, better known as the CARES Act. Following and during the presentation, there will be an opportunity for questions and answers as well. Our three speakers are all partners in the prestigious Dorsey & Whitney law firm. Dorsey & Whitney has locations across the United States and in Canada, Europe, and the Asia Pacific region. They provide an integrated, proactive approach to their clients' legal and business needs around the globe. Our first speaker will be Jillian Kornblatt, who assists employers with employment law matters. Jillian will be followed by Tim Goodman, who assists employers with benefits and compensation matters. Our third and final speaker will be Ken Logsdon. He assists employers with commercial, secured, and asset-based financings. It's important for you all to understand that APOS has arranged for these presenters to share their information, but this presentation is not legal advice. They're serving as presenters, and answering your questions does not create an attorney-client relationship with you. So thank you, and let's get started with Jillian Kornblatt.
Thank you, Christy, for the very kind introduction. This is Tim Goodman, and I might just make one comment. Thank you for making that note, but I'll just say it too. We appreciate the opportunity to be invited to present on this, and we're hoping that all the information that we provide tonight will be helpful information to you. If you do have specific questions, though, we are not actually your lawyers. I like to say that when I say this, it makes me sound more like a lawyer when we say we're not your lawyers. Instead, we're here to help APOS through this, and they've arranged it to try and help you folks through this. But you should reach out to your own counsel. One thing in going through the presentation tonight, we have this bullet point outline, and we are going to talk through issues. We'd love to take questions as we go. If we're getting a lot of questions, at some point we may have to stop. We have about, we for sure will go through 60 minutes, and we can even go up to 90 minutes here with the number of questions that occur. But do feel free to ask questions, and we will try to take them as we go so that we can help you with any questions you might have, and it'll probably be more relevant. And with that, now, Jillian, would you like to take us away, talking a little bit, first of all, about issues in terms of like termination and furloughs in these difficult times?
Sure, yeah, thanks, Tim, and welcome to everybody. So I will start out by saying, take everything we say with a small grain of salt, and the reason for that is the law here is just changing daily and hourly. I looked at some slides for a presentation my coworker gave this morning and saw that the Department of Labor came out with a rule today that changed what she was talking about in the presentation. So always a good idea to check back in, but things are as they are right now. So our focus tonight is really on how to help you run your business and keep it going during these times. So one question that we've heard a lot is what to do when you can't afford to keep employees on the payroll any longer. One option is a termination of employees, and the other is more of a furlough. Furlough is a word that people use for all sorts of meanings. There's no legal meaning to it, but generally what we mean by a furlough is that it is somebody remains an employee, their employment relationship isn't ended, but they're not working and they're not getting paid. Some employers do this while maintaining benefits and some don't, and I will let Tim, who's the benefits expert, talk in detail about that. I won't belabor that. So that's a big difference. Unemployment is generally available to employees whether or not they're furloughed or terminated. So somebody can apply for unemployment in either situation. And I'll go into more detail on unemployment in a few minutes. The The other advantage of a furlough is, well, there's several. One is you have a better chance of retaining your employees when the economy comes back and there's jobs. Some employers like to do a furlough so that their employees haven't left to seek other employment. Another is it saves, you know, the administrative, you're not doing new paperwork and new hiring and starting them on benefits and all of that. So unemployment insurance is a big topic as well. There have been a lot of changes to the unemployment legislation. Typically, unemployment statutes are done on a state level. So depending on what state you're in, the situation may be different. In many states recently, legislation has been passed changing unemployment to make more people eligible, to get rid of the waiting period that is typically there for a week or two before people can start benefits. So those changes have been in the works. In addition, the Federal CARES Act that was just enacted into legislation just a few days ago also gave additional unemployment benefits in addition to all the other things it did. So what that does is a couple of things, but it gives an enhanced, what it's called a pandemic unemployment benefit. It is not automatically available. A given state has to enter into an agreement with the federal government that they will eliminate that waiting period that I just mentioned, and also a couple other things that they need to do. If they do that, then there is another $600 a week added on to employees' unemployment benefits. So the interesting thing is that is not limited if it would bring the employee actually above their prior salary. That is only going to apply to lower paid employees because typically unemployment is about half, so they could only get above their prior salary if they made below $1,200 a week. So that is something. It's also extended the time when people could get unemployment benefits from 36 to 39. And so those are the actual benefit differences. The biggest differences are in who is eligible for unemployment. So it now will extend in those states that have agreed to it to people who are sick with COVID-19, people who are caring with others with COVID-19, people who are unable to work because they have children who can't go to school because of COVID-19. So it really expands the reasons it's available. And it also extends it so that it's not just traditional employees who can qualify for unemployment benefits. This is probably not as relevant to you if you're worried about your employees, but also independent contractors and so-called gig workers can also qualify for it. So those are kind of a broad overview of termination and furlough. If you have any specific questions, please write them in. We want to give information that's broad and hear from you on what specifics you'd like to hear. But I'll turn it over to Tim now to talk a little bit about some benefit issues.
Thank you, Jillian. So when you're thinking about termination of employment and furloughs, one of the things that comes up sometimes is questions about health continuation in particular, given this time. The situation is such with the termination or furloughing people that both of those situations usually then result in them being eligible for COBRA continuation coverage. And with respect to COBRA continuation coverage, that's something then where you have to go ahead and offer that to the employees so that they can continue their health insurance. In terms of COBRA continuation coverage, there's both, of course, the federal law and then there's state laws. The state laws generally reach down to just even one employee in terms of the number of people that are covered. And so whether you're terminating people or furloughing people, both those usually are triggers for those COBRA notices that need to be sent out. And in order to comply, then you should make sure that they're going out. I know a lot of people probably have very stable businesses. They may not hire and terminate people very often. But one of the things you want to be doubly careful of is to make sure that if you are terminating people or if people are having a reduction in hours, they're being furloughed, that you're providing those COBRA notices, especially to avoid any possibility of seeing penalties for failing to provide those COBRA notices or other action because someone fails to provide those notices. We are getting a few questions in, and I'll share them here. So one of the questions we just got, a physician employee who is furloughed, are they eligible for the CARES Enhanced Unemployment Benefit? And Jillian, I don't know if you've had a chance to think about that or look at that. I haven't looked at that, but that's one of the questions here by chance.
Yeah, if they meet the qualifications for unemployment, there's nothing that would exempt them because they're a physician. They would not receive their entire salary, but if they were furloughed due to lack of work as a direct result of COVID-19, our best interpretation is that that would be a qualifying reason. Again, this act is very new, just went into law a couple of days ago, and we haven't had Department of Labor guidance issued on it yet. With the Families First Coronavirus Response Act, the Department of Labor issued 3 FAQs. Well, it was one FAQ that kept getting longer in various days after the statute was issued and before the final rule and regulation came out, which was today. So we don't have that yet on the CARES Act, but I believe that a furlough due to a lack of work due to COVID-19 would be a qualifying reason. But there's no downside in the physician employee applying for unemployment benefits, and then the state will make the determination. Other than, I will say, the states are getting very overwhelmed with a volume of people right now, so it may take a little while.
All right, and now we actually have a series of questions. So why don't I pause for a moment before I talk more about benefits here and take some of these questions. And so Jillian, I'll come back to you maybe in a moment, but I'll answer one here. A question came in, are you required to give COBRA notification if you are furloughed, if you have furloughed employees, but you're continuing to pay for healthcare for your employees? And I guess the answer is if you're paying for all their healthcare and they're still covered, no, you do not need to give a COBRA notification. If at some point you stop paying for their healthcare coverage and they needed to pay for their healthcare coverage, that's when you would be providing the COBRA notification. Even if the two events then are somewhat separated, the time that they had the reduction in hours versus when they'd be losing their health coverage because you stopped paying for it, that's when you would then give the COBRA notice to folks that they would be able to continue their coverage. Jillian, another question that came in is, again, I'm asking Jillian these without knowing how much time she's had to read all the CARES Act, so you'll hear me apologizing.
Yeah.
But it says,
no, that's fine.
For physician partners, does it make sense to furlough ourselves if we're continuing to see urgent patients only? And I don't know if you have any sense of that by chance, Jillian.
So physician partners, should you furlough yourselves? Yeah, I think that is going to be, and this is a very lawyerly answer, but a partner would be likely considered a business owner. I think state law may vary on what unemployment benefits are available to business owners and how that is viewed. Here in Minnesota, where we are, they just extended the time that business owners can get benefits. It was normally a limited period of time. So I would advise checking in with the state unemployment department wherever you are and asking that question if you want to know before entering in, putting yourselves on furlough. That would be my advice.
And Jillian, there's several questions along the following lines. If you're can highly compensated or salaried employees receive unemployment? And another one is if a highly paid employee, such as a physician, reduces their wages from say 200,000 to 100,000, are either of them eligible for unemployment insurance if they have reduced salaries given what is happening in the economy?
Yeah, so that's an interesting question. So reduced salaries alone in most states do not trigger unemployment benefit eligibility. And I can't say for sure that that would be every state, but we've looked at this issue to some extent and it's not typical. typically unemployment eligibility will start when either someone has no work available, which is obvious, or if their work has gone below a significant threshold in hours. So excuse me, here in Minnesota, if somebody's work has dropped below 32 hours for a part-time employee, there can be some eligibility, and it's a prorated amount, so you're never going to get above the maximum amount. But there isn't anything so far to compensate for pay cuts. That is happening incredibly common now for employees to get pay cuts without a reduction in hours that matches. There is some talk that this is an issue that may be taken up by state legislatures, kind of a make whole program where employers could pay some and unemployment could pay some to get employees to a full amount. My guess is if that ever happens, it's going to have a maximum cap. And so I don't think it would be likely to cover this, but as of now, I'm not aware of that existing.
Okay. Say there's a couple COBRA questions, so I'll take them here real quickly. What if you aren't paying your employees' entire cost of the premium? Say you're paying 50%. Do you have to give them a COBRA notice, I guess is the question, or what happens there? Well, if you're paying 50% of someone's health premium, if they were to stop paying the other 50%, then they'd be losing coverage because they stopped paying their portion of the premium, and I don't think a COBRA notice would be required. But again, each state has its own, many states have what they're called mini state COBRA laws, and so you may want to just check the guidance in your locality, especially if you're a small employer, to see what the rule is there. Also, you could talk to your insurance carrier, who is probably going to work with you on that COBRA. Then another question here, if you have only 7 employees and an employee has only been there for 3 to 4 months, do they get 18 months of COBRA? Or again, and when I say COBRA, just to be clear, many states, as I said, have these state statutes that were enacted before COBRA, but still apply to insured health plans, and so they probably apply in many cases to the people attending this conference. Again, you'd want to look and see if there's an exception under that state continuation coverage law. I think that once a person is eligible for your health plan, then they are eligible, generally speaking, for continuation coverage. And so theoretically, the premiums for COBRA are, it's usually said 2% on an administrative fee and 100% of the premium. So that should cover the cost of COBRA. And so I think they would be entitled to COBRA in that situation. Let's see here. Maybe we can just take one more question and then go back to discussing things here just a little bit. Let's see. If I am a sole proprietor owner and I am closing my practice and not seeing any patients for the duration, am I entitled to unemployment in California? And Jillian, I don't know that you know that, but maybe you have suggestions about how they could help get guidance on that.
Yeah. I really, that would be just a matter of the California unemployment code. So I don't know the answer to that question, but I would encourage you to reach out online, is probably best these days, to the California department that handles unemployment, and you should either be able to find the information or contact somebody to find out. I'm going to take one more quick question, Tim,
please,
if that's okay.
Please.
Since I didn't have an answer really for that one. So somebody asked about what to do if employees are already furloughed and they want them to come back to work, how they're going to convince employees who are furloughed and presumably getting unemployment benefits to come back to work when some of them may even actually end up getting more in unemployment. So unemployment isn't an option. So if they are offered work and turn it down, unless they have another reason why they have to turn the work down, such as being ill themselves with COVID-19, caring for somebody, having a child that they have to take care of because there's no school, then they would have to go back to work. And if they didn't, because they've been offered a job, it would be considered in most states ineligible for unemployment benefits.
Okay. We are getting so many good questions, but I think we may stop and come back to some of the questions here, and I may just talk for one more minute about the last bullet. about retirement plans and issues that are coming up here in terms of retirement plans. I'll talk about the CARES Act and some changes made to help people later. But first of all, if you have a retirement plan and you have employees, one of the things you need to think about is if the employee asks for help, what might apply in terms of financial help. Well, the CARES Act, as I say, I'll get into, but even without the CARES Act, there's several things. A person may be eligible to take a loan if your plan allows for loans. If they needed financial assistance, plans can also allow for distributions, a 401k plan at age 59 and a half without for basically any reason. So that's another way to get folks money. One thing an owner though should know is that if you terminate employees and you terminate 20% or more of your workforce, that then there's a rule known as partial plan termination. And in that case, you have to vest people. If you have a vesting schedule, let's say that you tell your employees, hey, if you work for me for 2 years, the contributions I put in will vest then. If you terminate people and it's a partial plan termination, then you would have to go ahead and vest them. So that's one of the special rules out there to just be mindful of. Jillian, I don't know if you've seen other questions you want to take for a moment here. Otherwise, maybe we would turn to reductions in compensation.
Okay, sure. I can do that. So, I think we actually have talked about reduction in compensation through one of the questions. So, I don't know, maybe there's another question related to that, but I think we've basically talked about that. So I'm going to jump to the emergency paid leave under the Families First Coronavirus Response Act, the FFCRA, and I see we've had at least a question or two.
Yeah, if you don't mind, then I might take one or two quick questions here and just
Sure.
check them off. Okay, so one is, do you have to vest someone if you furlough them? And the short answer is no. If they're not being terminated, that's not, they're still an employee. But if you eventually let's say you first furlough them and then terminate them, over time you might have to vest that person, right? Again, it depends on if you end up terminating 20% or more of your workforce with respect to this. Is the 20% termination for vesting, does that apply to all employees or apply to terminating all employees or all current 401k employees? Just those, it's a good question, so I'll rephrase that because I didn't say it very well. Who gets to be vested based under this rule? It's only people who are not fully vested who are terminated. And so let's say you have that there's 10 employees and you have to terminate 6 of them, right? And of those 6, 2 are not fully vested. Well, you'd have terminated more than 20%. And so the 2 who are not fully vested, you'd have to vest. Now the other 4 are already fully vested, so there's nothing to be done. The good news is that the money is already in the 401k plan, so it's not that you have to make an additional contribution. It's just that when you terminate those folks, they're going to become entitled to the employer contributions. There won't be a forfeiture of those contributions. And sometimes, obviously, there's a vesting schedule to try and encourage people to stay or allow employers to reuse that money for other people. And I was going to look, I think there was one more question. And I know one last thing I'll say while I'm looking at the questions here. I know we're getting several questions about financial assistance to organizations, and I think I can speak for Jillian and myself by saying that unfortunately is our colleague Ken who will hopefully be able to answer those questions. And so the reason we're not trying to tackle any of them is just because of the fact that we are not the people who are knowledgeable about that. With that, Jillian, maybe we'll go ahead and go back, and if you want to talk about the emergency leaves for a little bit, we did have that one question or so earlier, I think, but that'd be great. Thank you.
Yeah, thanks, Tim. So I'll give a brief overview of it. So the FFCRA provides 2 kinds of leave: emergency paid sick leave, and that is up to 80 hours, so 2 weeks of a full-time employees, or a prorated amount for part-time leave. It's at 100% pay up to a cap, and it is for employees who are sick with COVID-19, who are have to stay home because of a doctor's advice to stay home regarding their own health status, and that can be either because there's a risk they've been exposed and they're self-isolating, or they have a prior health condition or something else that makes them more susceptible, so their doctor has advised them to self-isolate, or a state quarantine or isolation order. Those are 3 areas. All of those, the employee is able to get paid up to $511 a day, and that will be reimbursed through a tax credit. We are told that the IRS is working to get those reimbursements to happen faster so that businesses don't have to wait so long to get the credit. The isolation or quarantine order, it was unclear what that meant until the new regulation came out today, but we now know that it is more broad. So many states now have stay-at-home or shelter-in-place orders, and those would be qualifying reasons for employees to get those sick time. Employees are also eligible for the sick time if they are caring for someone with COVID-19, or if their children aren't in daycare or childcare because they're closed and they need to care for their children. In those situations, they're still entitled to the 100% pay, but up to a cap of $200 a day, also reimbursable. So that's the overview of the sick pay. The FFCRA also provides emergency family medical leave. This is to be used only for one reason, and that is if an employee has children they need to care for due to school or daycare closure, they can take this. It's 10 weeks. They get paid at 2/3 of their salary, also reimbursable by the government after that ends. So we got a question that brings up a really important issue for this group, which is asking about the FFCRA. There's a healthcare worker exclusion, and that is true. So the FFCRA excludes healthcare providers and emergency responders. Again, initially, healthcare provider was defined very narrowly, but the DOL has now expanded that so that it is essentially any employer of a healthcare provider can now be excluded. This is something that is left to the employer's choice. So the employer gets to decide, are they going to provide this benefit or not? And so it is something that you can consider. There's a question if you do that, if there's a risk that reimbursement will be denied. So you would want to make sure that you have, well, you'd only be getting a reimbursement if you paid them the benefit. So if you're excluding them from the benefit, they're not getting the sick or the FMLA benefits, there would be nothing to reimburse. And so the Department of Labor describes that as an or situation, so you could choose to exclude them from one type or the other. But that I'm sure is very relevant to your practice groups.
Hey, I'm sorry to jump in. Jillian, can you hear me okay?
Is that Ken?
Yes, can you hear me now?
I hear you.
Yes, Ken, we can hear you.
Okay, yes.
Great.
Hello.
I don't know why, but the other avenue just kept putting me in listen mode. I apologize to the audience, but now you have Ken on.
Oh,
Well,
thank
good.
you, Ken.
Glad you're here. Glad you're here. So,
Go ahead,
Ken, we're
Jillian.
kind of just tugging questions and going through our agenda, you know, kind of in different orders. So if you have any questions that you've seen that are in your area, feel free to take one of those now. Otherwise, I think we are about to talk about some benefits issues.
Yes.
Yeah, I would hold off until I can do a quick summary. I mean, I literally have 200 emails in my inbox just today alone on questions on the stimulus and the CARES Act. So I couldn't even start to tell you what questions I've been getting. But when it gets to that portion in this webinar here, I'll give a quick summary, and hopefully that'll elicit some questions from the audience, and I'll be happy to answer those.
Sounds
Perfect.
good.
So, Jillian, real briefly, maybe we'll go back and catch a few questions here. One question that came up a little bit ago was, does a furlough need to be provided through a formal written notice to the employee? And I think that's a little more you than me, but what would you say to that maybe, if you're putting someone on unpaid leave?
Sure. There generally is not a requirement to give a formal notice. I would recommend doing it so you have a record of what's done and the employee has a record. The employee may also need something to take with them or to upload online for their unemployment benefits. So I would advise giving them something in writing.
And here's a few questions, Julian, if you don't mind answering them that had come in. And first of all, I
Sure.
want to say thank you for all the questions. This one
Yes,
was,
thank
what if an employee does not want to come back to work because they are afraid to be exposed to the coronavirus or COVID-19? What sort of employment action do you take in that kind of a context?
Yeah, that's a great question. And we have had that question a lot. And based on our current interpretation of these laws and what's out is there isn't really a leave mechanism available for employees in that situation. They really need to get any of these benefits. They either need something, a medical reason, something from a doctor advising them to isolate would be a way that they would then be eligible for these FFCRA benefits. But if it is just them saying that they don't want to work because they're scared, although that's understandable, it would not make them benefit eligible. And as a healthcare provider, particularly, you could, at that point, you could terminate them for not working if you wanted to take that action. So that is an available option.
And I'll take an easier one here. What is the FFCRA? And that's the Families First Coronavirus Response Act. And if you hear about all the bills that Congress is working on, so that is the one that provides for the emergency sick leave and the emergency family leave. That was passed and enacted, I believe it was on March, it was at 18th or so. And now this last week we had the CARES Act, and that was sometimes referred to as phase 3 of the legislation Congress has put in place to try and address this. So that's when you hear us use an acronym, the FFCRA was phase 2 and CARES Act is phase 3 of the different legislation that's been enacted. On a related note to the last question you answered, Jillian, there was a question about what happens if a person does not meet one of the six leave. So there's 6 reasons behind why a person would qualify for the emergency sick leave, as you kindly discussed. But what happens if somebody is so afraid to leave their home because of a potential exposure? Do they still get some type of leave? Is there a paid leave for them under either the emergency sick leave or the emergency family leave?
No, not unless they meet one of those six reasons. So there wouldn't be one just for somebody who's fearful.
Okay. And let's see, we've gotten a few more in here. Let's see. Oh my gosh, lots of questions. I'm sorry, and they're coming in so quickly. My questions are jumping on me. Just a second here. Did you say that, I think this is maybe you, Jillian, if you don't mind. It says, did you say that as healthcare employees, you don't have to offer Emergency Family Medical Leave Act time or extended time off with full pay under the FFCRA? So the 2 types of emergency leave, the emergency sick leave and the emergency family leave, you don't have to offer that to healthcare workers. Is that true?
That's true. So as in the rule, I'm sorry, in the FFCRA, there is an exclusion for healthcare providers, and the meaning of that was very narrow, but the Department of Labor put out guidance saying that a healthcare provider could essentially be any employee of a health entity of an employer of a healthcare provider. So yes is the answer. You can exclude employees from that. You do not have to offer it to all your employees. I would say though, if you are going to do that, make sure you tie that to a legitimate business reason. So for example, you are going to exclude all the nurses in your office. You wouldn't want to say, yes, this person, I'll exclude that person, I will let you take the leave. That could be risky.
Okay. And if you don't mind, Jillian, I might share one or two more of the questions that have come in. I think these are more for you than me, but if a physician salaried employee is converted to commission only, is that physician eligible for unemployment? And I'm guessing that's probably a state-by-state analysis, but I don't know if you have a better sense of that.
Yeah, I don't know either. Unemployment questions are difficult because it's state unemployment laws control that. But again, as a general principle, there isn't a mechanism typically for unemployment as a result of a drop in pay. So if the commission pay results in lower pay, that would typically not give eligibility for unemployment benefits.
Okay. And let's see, I'm just going to take one more look at the last couple questions here. And some of these questions I think are going to be more geared towards Ken when he joins us. So we'll go from there. One last one here, maybe. Would a clinically diagnosed anxiety allow employee benefits under the the FFCRA, the Family First Coronavirus Response Act, as a medical reason for accessing those leaves? And you can tell me, Jillian, too, but I think the answer is no. I think it would qualify you perhaps for the unpaid regular FMLA leave if you had a person who, because of anxiety or some other medical situation, was not able to perform work. They might then qualify for FMLA if they met the other conditions. But as Jillian had laid out earlier, the emergency sick leave, there's only 6 reasons that allow for the emergency sick leave. And for the emergency family leave, it's really to care for children who, because either their school is closed due to the coronavirus or their daycare provider is not available. So I don't, correct me if I said anything wrong there, Jillian, I defer to you, but I think that regular FMLA may be available, but not the emergency paid leaves.
Yeah, I agree with that. And Tim's thought about, traditional FMLA hasn't gone away, so that is still always there and available. If the employee, it would depend on how the doctor worded the note. So if it just says employee has anxiety and cannot work, then I think that what Tim said is exactly correct. Regular FMLA perhaps, but not this emergency leave. It may, however, qualify for this sick leave and not the FMLA, because not the expanded FMLA, that's only childcare, but it may qualify for the sick leave if the note says employee has high anxiety, employee should self-isolate during this crisis to avoid undue anxiety about exposure. In that case, I think you would probably want to give the leave. But that said, you are a healthcare provider, so you always have the option of excluding somebody from that leave based on that fact. But I wouldn't do it with just one employee based on the fact that she has anxiety, or else that could be viewed as disability discrimination.
Okay, why don't we return to our agenda here? So the last heading is benefits, and talking about benefits for employees in this time and some of the changes in the legislation. So one thing some employers have already mentioned as part of the webinar here is that they are subsidizing their employees' health care, and there's nothing at all wrong with doing that. In fact, I'm sure reassuring your employees that you're willing to help them and take care of them, obviously, in this difficult time. Employers can subsidize COBRA. They can also subsidize the regular health coverage. If they're not paying 100%, they can subsidize the entire amount of the premium. And that's the thing that I think, if you're considering what people might be interested in, when I've talked to clients, they're looking at terminating or furloughing people. Usually the thing that they're talking to me about is there a way we might be able to subsidize these? Or if their finances are such they can't subsidize them, whether it's better maybe to then terminate the person or do something in order to allow them to go to the exchange where they might find cheaper coverage. If a person loses coverage either because of a reduction in hours or because they're terminated, generally speaking, they should be able to either hopefully get coverage through their spouse, if their spouse has coverage, if they're married, or through the exchange. And so that's an option too to consider as you're having to take employment actions. And the other thing here, and this is very recent, is some recent changes under the CARES Act to give employers an opportunity to allow their employees to access more of their 401k accounts in case there's a financial need. So let's say that you still have an employee, obviously, that's working, but maybe their spouse has been laid off, and that person now is finding themselves in the state of some financial distress. The CARES Act had made several changes for individuals who are affected by the coronavirus, either individuals who actually have had the coronavirus or tested positive for it, if their spouse or dependent has tested positive, or if they have a financial hardship due to the coronavirus, such as being laid off or having had some other event that has led to a financial hardship. There's a list in the CARES Act. You can amend your 401k plan or a retirement plan for an employer to allow for the following things. So with respect to, say, a 401k plan, you can amend the loans to allow for larger loans under the plan. In essence, right now, loans under a retirement plan are limited to $50,000. The CARES Act has increased that to $100,000. In addition, loans were limited to 50% of a person's account value, and now they've been increased to 100%. So you could allow for these larger loans in your plan. Another thing the CARES Act allows for is if people have outstanding loans where payments are due this year, you can work with your vendor to suspend those payments so they don't have to do repayment now and instead will do repayments next year. So that's another way to alleviate some of the financial burden. And then the other thing is that you can amend your plan to allow for a distribution of up to $100,000 for people who've been affected by the coronavirus in this way. That $100,000 distribution can actually be repaid over 3 years, in which case it would never be included in income. So that gives individuals an opportunity to access some cash and then to repay it and not have it included as taxable income. Or they, of course, could just use it and not repay it, but then it'll be taxed over 3 years. So those are the changes under the CARES Act. The CARES Act also suspends minimum required distributions for former employees, and that's a helpful thing in terms of people whose account balances have gone down significantly so they don't have to take money out, especially when it's in a down period. If you're an employer and you're interested in any of those things, I would suggest that you go ahead and you contact the vendor that you work with, and they can talk to you about what you need to do. My understanding from talking to several vendors is basically they'll accept direction from you about implementing of those things, and they will implement them as soon as practicable. And then at some point, you'll adopt an amendment to your plan. But those are all in the CARES Act, which was just passed this last Friday as a means of allowing people to access more money in case they do have financial needs. And again, the one that comes to my mind is, let's say you have an employee whose spouse has been laid off, and so the family income has been cut, and so that's some of the reasons they'd want to go ahead and be able to access those. We have a number of more questions. I do think, though, that we've gotten a lot of questions, Ken, that are questions, and I don't know if you have your computer screen up, and if not, I can read you some of these questions, but maybe, Ken, we should turn over the program to you at this point so that you can talk a little bit about the financial assistance available. Are you ready, Ken?
You bet. Happy to do it. Thank you.
Yes, please.
Again, apologies to the audience for the technical difficulties here on my end. So just real quick, when it comes to the CARES Act and the financial assistance, it can kind of be broken down essentially into 3 different categories. One category is the SBA related items. The second category is what's being called the mid-sized business loan program. I think, if I'm not mistaken, and Tim, you can tell me if I'm mistaken on this point, the mid-sized business loan program is designed for companies with 500 or more employees up to 10,000 employees. I suspect we don't need to get into the details on that, or is it appropriate to spend a couple minutes discussing that piece?
I think we can skip that piece, yes.
Okay. So if you're interested, you can look into it, but in short, that's going to be handled by the Treasury and the Federal Reserve. Not a lot out there on that particular program. Very, very little detail. And so, how that's going to look is to be determined. But due to the audience here, I believe what everyone's really interested in hearing about is what's called the Paycheck Protection Program or the Disaster Relief Program. Now, the Disaster Relief Program, I'm going to talk to you about that first because they're different, but they overlap and they dovetail under the Act. But the Disaster Relief Program is essentially, it's a traditional SBA program that was put in place for purposes of disaster relief, and including economic injury, such as what most companies are experiencing here in connection with COVID-19. What they've done under the act there is essentially the entire country is now declared a disaster area, and that allows small businesses across the country to take advantage of these disaster relief loans. Just briefly, these loans are up to $2 million. Interest rates of no higher than 3.75%. It's a needs-based analysis, and that also includes the amount and the repayment. And it's essentially treated like a bank application, and it can have a term as long as up to 30 years. Again, it's going to be tailored for the business. The other features to it, however, the drawbacks: non-forgiven. It's a loan, and you got to pay it back. If the amounts that you receive are in excess of $200,000, it's now going to be recourse, or you're going to be required to provide a guarantee by a principal or an interest holder that has more than 20% of the equity. And it's a very low threshold, but if the loan amount's over $25,000, collateral will be required. So that's the basic feature there. The one interesting element to that program is it was essentially designed for small businesses as defined under the SBA, but they broadened it as well in connection with the CARES Act to include up to, businesses that have employees up to 500 employees and count to complement the Paycheck Protection Program. Interesting tweak there. And by the way, they just threw that in, and they didn't actually include any of the other exclusions that are found in the Paycheck Protection Program. And I'm going to refer to that now as PPP for short. And so to me, that's a disconnect. And so they don't really work nice together, but they've intended that to be the case. So as I move towards discussing the PPP program, how does that dovetail with the disaster relief loan? Well, let's look at it this way. If you got a disaster relief loan today or anytime after January 1st of 2020, you can also go ahead and qualify for the PPP program, and the disaster relief loan won't count against you, and you can use proceeds from the PPP program to reimburse you for the disaster relief loan. So keep that in mind. And that's really about where they overlap, and that's where it ends. But the real substance of the CARES Act when it comes to stimulus with respect to any kind of financing is the PPP, the Paycheck Protection Program. And I think it's helpful to envision a grant. You see the industry is throwing around that term. I think it's probably okay to call it a grant, but it's not quite appropriate, because you're going to see after we're done here in the next 5 minutes, ideally, so we can have time for questions, that it isn't a full-blown grant, but it is free money to the extent you can get it forgiven. So in short, it's going to be a loan. It's going to be a loan up to the lesser of $10 million. And in short, 2.5 times your monthly payroll expenses. So you take your average monthly payroll expense, and that includes salary, that includes benefits, that even includes any kind of compensation for state and local taxes. But it does not include FICA, and this is becoming a problem. I don't know if we're going to have questions on it. We don't have a lot of clarity on how FICA gets backed out. So it doesn't include FICA, it doesn't include federal income tax, and it doesn't include any amount in excess of $100,000 for any particular salary that you're considering. So there's been confusion on that. You do get the credit for each employee regardless of how much they make, but if they happen to make over $100,000, for purposes of the loan amount determination, you're only going to get credit for the first $100,000. And the average is over the trailing 12 months. You do a 1-year look back. You take each period. Let's say, for example, the period for your business is 1 month, and you take the average of all of those months for payroll purposes, and then you times that by 2.5, and that's your loan amount. Once you're given that amount, and you can expect to receive that amount, in the application process, there's a couple things that you need to certify to. You need to certify to the use of proceeds. This is important because this is designed to essentially cover paychecks for 2.5 months at the end of the day. And the use of proceeds can only be towards payroll, of course, mortgage and rent, and utilities, and any other debt obligation that you incurred as a business or a sole proprietor or independent contractor prior to and pursuant to agreements that were put in place prior to February 15th. So if you have a loan out there, if you have a company where you actually have a couple trucks and they're purchase money or capital lease arrangement, you can maintain the payments. The interesting tweak there, though, it's only interest payments. Not many capitalized obligations are just purely interest. So that's the drawback. You're not going to be able to apply any of the proceeds from this program towards maintaining principal payments on outstanding indebtedness. So that's something you got to bear in mind. And the same goes for utility payments. They have to be pursuant to arrangements that are in place before February 15th. But that's the world of use of proceeds. And if you run afoul of the use of proceeds rule, in the law, there is this statement that to the extent you do that, the loan could become recourse to the owners of the company. So it's going to be really interesting to see how that is tracked. I personally don't believe that's really terribly feasible, but if they were to catch a company using the proceeds towards some other purpose, you're going to get slapped for it, and it'll become recourse, and they can go after the owners if you don't pay it back. However, you're probably not going to be all that incentivized to use it for other purposes, because I think the real intent here is to treat this like a grant, and that speaks to the forgiveness feature. And so let's look at this in three buckets. We got apples, oranges, and bananas. The apple's the loan amount, 2.5 of your payroll. The orange is use of proceeds, and then the banana is the forgiveness. And I bet you're going to guess, yes, that's right, they don't line up. When it comes to the forgiveness feature, what they do is they're going to be looking to the 8-week period starting the very day you received the loan. And you're only going to get coverage for 8 weeks. Now, think about that for a second. The loan is 2.5 months payroll, but you're only going to get covered for 2 months. Oh, no, by the way, you do get covered for other things than payroll. They will cover for 8 weeks of payroll, rent, mortgage, and other debt obligations and utilities. But again, it's an 8-week period, and the clock starts the minute you get the loan. And how that process works is at the end of the 8-week period, you reach out to the lender, you send them the appropriate documentation evidencing your expenses for those 2 months, and it's supposed to be a streamlined approval and forgiveness process whereby 90 days later, the SBA actually purchases the loan from the lender, and you're forgiven for that amount. What happens to the portion of the loan that didn't get repaid, because it's theoretically possible that your loan amount was actually greater than the forgiveness feature? That gets termed out. It gets turned into a regular loan, no longer than a 10-year term, no greater than 4% interest. But bear in mind, you're not going to have to pay anything on this until at the very earliest 6 months out, up to 1 year. That's baked in. There's a deferral feature that's already baked into the law. So you don't have to worry about maintaining this loan either prior to forgiveness or even after forgiveness, provided you're within you're within the 6 month period after receiving the loan. So I think that's important to keep in mind. So what else is there that's unique about the forgiveness? Of course, it wouldn't be that simple. What happens if you've laid or furloughed employees or reduced salaries? That's going to affect the and this is important. There's been a lot of confusion around how this is supposed to work, but these dates are critical. That people have asked, when can I lay people off and bring them back on and not get dinged for it? Well, the dates in the act right now are February 15th to 30 days after the act. Okay, I think that's April 25th. That's the end of the third week of April. So if you're in tough times right now and you're thinking of laying people off and you still want to take advantage of this program, but you're also realistic, and you should be, that you perhaps aren't going to see a penny for a week or two, then let's cross our fingers, even if it's in 2 weeks. I think the federal government's doing amazingly, but we'll see how this thing rolls out. Then you still have the ability to do that. You could furlough your employees or reduce salaries. And to the extent you do those activities before the 30 days after the act, April 25th, then you won't get dinged for doing that. Those reductions aren't going to count against you for purposes of the forgiveness, provided you rehire those employees to the same status or restore the salary to the same amount by June 30. So you have to take that action. And that's why the forgiveness feature is after you submit your application, there's a 90-day process. As you can see, there's time there it needs to roll off to make sure that you've actually lived up to your side of the bargain and have restored the status of your employees and the salary levels. Now, when it comes to the salary reduction, there's another fine subpoint to make there. You're not going to have to worry about any kind of restoration to 100% of the salary if the reduction is less than 25% of what their salary was. You're only going to be required to restore salaries in excess of a reduction that's in excess of 25%. I think I covered it pretty thoroughly, at least a very solid overview. Now I'm prepared, Tim, if you don't mind. I do not have the questions in front of me, but maybe you can just take them in turn and see how many we can get through.
I'm happy to read them off to you here, Ken. So let's go through these. Let's take this one. If I start my business on February 1st of 2020, what salary look back do I use? And I don't know that there's any good guidance on that yet, Ken.
Yeah, so if you have a truncated, and that's, I like the date of that question, by the way. The one thing that's important to keep in mind here for the audience is only businesses that were in operation February 15th, right, and had employees February 15th. If you're a new business, you started your business after that date, you're out of luck, unfortunately. The program will not be permitted to be used for that particular business. In this particular case, the statute anticipates very young businesses that have a very short lifespan leading up to February 15th, and it's essentially a prorated analysis. They will take your expenses or your payroll, whatever you need to calculate prior to that period, for purposes of determining how many employees you have and for purposes of determining your payroll expenses. You just have to take the average over that truncated period.
And so that's great. I'm going to just read through a few of these other questions here, and then we can see about going from there. Can you use the PPP money to pay the interest on a person's line of credit? Is there a restriction, maybe another way to phrase that, or what are the restrictions, if any, of using the PPP money? Do you have to use it just to pay the salaries, or you get the money so that if you are continuing to employ people, you get the money and that's fine and there's no question of how it's used? How does that work, Ken?
So that speaks to, I think, how you have incurred obligations as the business, right? If you have practices in which the business has a credit card, no question, interest can be paid there. And again, use of proceeds can be used for other purposes. However, it will become recourse, i.e. the owners of the business will be liable for those amounts. And now that particular feature is very unclear. The law, we hope to see some additional color over the next few days by the SBA and the Treasury. But as I read that, I read that as if they see that you've used the proceeds for other purposes, they're going to immediately pursue an owner. But it's unclear if that's the case. It could very well be that if it gets termed out, and by the way, you're only going to get credit for forgiveness to the extent it's been used for that very limited subset of expenses, and you have to show that, you have to evidence that, you got to prove that, you got to certify to it. So you're not going to get coverage there. But to the extent you term out the loan and you happen to use the proceeds of that remaining amount to go buy yourself a Ferrari, I mean it's unclear how that would look. I suspect they'll have the ability to go after you immediately, and it might be an acceleration feature in that loan. But those types of details are to be determined.
Okay, so this is one that might cross all three of us here, but I'll take a stab at it, and then Jillian and Ken, you can correct me if I'm wrong. We've had a couple of people ask this. Can an employer both apply the 2 weeks of emergency sick leave and then where they would be able to then to request or claim the tax credit, the payroll tax credit, and also get 8 weeks of forgivable qualifying payroll expenses under the PPP? And I'll take a stab and I'll let both of you comment on this. I don't know that you can't do that. I think you probably could do that. The one thing is, I don't think you can use the PPP amount to pay for either the emergency sick leave or the emergency family leave. And so let's say you had 5 employees and you choose this 8-week period to have support for your payroll. And let's say an employee during that time requests emergency sick leave. You wouldn't be able to use the PPP for them during that period of time, is my understanding. I don't know if either of you have looked at that. And again, I apologize, the CARES Act is so new and we're still digesting it, but I think that would be my understanding.
I could speak to that, Jillian, unless you prefer to.
No, I was gonna say I'll punt that one to you, Ken. So perfect.
Fantastic question. I appreciate whoever asked it because I should have, in my summary, made it clear. When you are going to calculate your payroll costs, I did talk about FICA. I did talk about federal income tax. I left off that other category. That category is if you're taking advantage of the tax credits in the form of the Family Leave or Sick Leave Acts that have been implemented, you also don't get the benefit of that. So yes, you can use them in, concurrently. Sure, you can take advantage of both programs, but it will merely reduce the loan amount that you're going to be entitled to.
Okay.
Ken, could you use them consecutively? Could you do 2 weeks under the sick leave and then use the loan for a different 8 weeks?
I think you could. The tricky thing is this: if you have an employee who qualifies for one of the 6 reasons, and Jillian in a moment will have a question for both of us about those 6 reasons and whether a state stay-at-home order qualifies as one of those 6 reasons. That's the one I was going to ask you in a minute. But I think the problem would be this: let's say that you choose, and Ken, correct me if I'm wrong, you choose your 8-week period. Let's say your 8-week period begins as of May 1st and it goes through basically the end of June. During that period, you're going to have the payroll protection apply. Well, if someone requests either the emergency sick leave or emergency family leave during that time, I don't think that you'd be able to deny that leave for them. I think you'd have to be able to provide it to them in paid leave. And then because you're getting the payroll tax credits that you in Social Security and so forth, that's when I think that it might be hard to time this. In other words, I'm thinking you could use them sequentially, and maybe everybody will have used their emergency sick leave and emergency family leave by May 1st or something. But otherwise, it's going to be such that you can't. I think the government looks at it as sort of double dipping, that you couldn't use both the pay protection and get the credit against the amounts you're paying out through reductions in what you have to forward on to the government. Ken, I don't know if you have any comments on that, but that's how I'm understanding it.
Yeah, no, it's a great question. The timing is a little uncertain. How I envision this, to answer the question properly, is you get the PPP and then day 2, you start taking advantage of those credits. And so let's make that simple. I'm not sure how that would look exactly for your tax treatment purposes, but let's assume that's how you can do it and take advantage of the tax credit. I think what would happen is your loan amount has already been determined because you have the loan, but there's absolutely no question on the back end, on the forgiveness side, you're not going to get the benefit of that. That would come out, and you're going to be certifying to the true expenses. So I think you're going to be playing a little bit too fast and loose if you aren't honest about any kind of credits that otherwise wouldn't have factored into, quote, the payroll cost.
Mm-hmm. Yep, that's a better way to explain it. So Jillian, we've had this question asked where basically is a stay-at-home order. So there's 6, just to give everybody the same background. For emergency paid sick leave, there are 6 reasons that a person's entitled to that. And the first one is an employee is subject to a federal, state, or local quarantine or isolation order related to COVID-19. And one of the questions I think a lot of people have had of us is, in essence, well, is a state stay-at-home order then or a shelter-in-place order, is that one of those 6 reasons? Is it that first reason, or does it qualify as one of the other reasons? Would that entitle someone?
That is a great question. And if you asked me that question this morning, I wouldn't have an answer for you because it was just not clear. And the language in the FFCRA uses, as you just said, isolation order, quarantine. But the Department of Labor regulations issued just this afternoon do clarify that yes, stay at home or shelter in place, either of those kinds of orders would count under that provision. So they would be entitled to use the sick leave for that.
Great. And Jillian just made an excellent point that I'm going to echo. She said this earlier at the start of the program too, and that is the guidance here is coming out, and it's coming out quick. And literally, I think it was last Wednesday, the Department of Labor issued their first frequently asked questions on that Families First Coronavirus Response Act and the Emergency Sick and Family Leaves. They've updated it and expanded it twice since last Wednesday, and now they've issued some regulations and guidance there. So you can see how quickly these things are developing. And so this is one thing where it's like you have to practically go back on a daily basis like we do and see if there's more clarity sometimes with some of these questions. And so even the things we're saying now, if someone were to listen to this as a recorded program, say a week from now, there might be more guidance and we might change some of the things we're saying just because of that.
Yeah.
Hey,
Let's see.
Tim, can I elaborate on that a bit?
Oh, please. No, that'd be great, Ken.
And it speaks to the overall kind of program. The one thing I haven't touched upon, and I purposely didn't touch upon it because it's very complicated. And if you ask any questions on it, we'll do our best to try to tackle them or just not address them because it is incredibly unclear. But for much larger companies, and we're talking about companies that are bumping up against the 500 employee rule, and I suspect that's not the majority of this audience, but in case there are a few out there that are dealing with that, there's this issue of the affiliate rule that's baked into the SBA regulations. And unfortunately, under the PPP, companies actually have to live with that. And unless you're in the hospitality or food services business, and unless you're getting financing from a small business investment company, so there's that too, I'll throw that out, you are going to be subject to having to run the affiliate rule analysis. And that means when you determine how many employees you have for purposes of determining that you have 500 or less, you have to pick up your affiliates. You have to pick up all entities that control the company and the entities that that company controls. And you also have to do the brain damage of picking up not just ownership, but also control. So any entity that actually effectively completely controls the management of the company, but has zero equity stake, for example, is now an affiliate under the SBA rules. What does that mean? Well, then now that company is going to be part of the group in which you have to count for purposes of the employee base. Now, for very large, complicated structures, you can imagine in the business community, this is an absolute nightmare. And I think for the most of the individuals listening on this call or attending this webinar, it's a non-issue. But I think it's worth highlighting. If you're a physician, for example, who owns your own practice, you have 25 employees, and you also happen to have a real estate business on the side. And that real estate business is also the landlord of a couple of your practices. And in that real estate business, you have a staff of 20, and you control both, right? Under the regulations, you actually have to include that is one giant application. That's one company from the perspective of the SBA. And then you have to take the employees and make sure you don't run afoul of the 500 employee rule, keeping that in mind. Now, I'm just going to stop there because this is incredibly nuanced. This is one of the biggest problems with the PPP, and it actually hasn't even been, things have gotten worse. They put out a sample application yesterday, the Treasury and SBA did, and they had one question that spoke to this, and it didn't even really speak to the right question, and now everyone's really confused. So, things are moving quickly, and unfortunately in this particular case, we're not seeing additional color that's all that helpful. And so we're hoping over the next several days, probably a week or so, there's going to be more that comes out on that point. If you have a larger, more complicated company structure, just pause and consider what your affiliates might be, because that's a question and analysis that must be ran.
So Ken, I'm going to ask you a few more questions that have come in here. And I apologize, some of these may be very nuanced, but some of them hopefully will help people who hadn't thought of some of these things too. So Should a separate bank account be open to keep your PPP loan proceeds segregated or so you can better track them? Do you have any thoughts on that?
I mean, that'd be an ideal world. I mean, I think it's important to put this into perspective. This is going to be, first of all, this is kind of the flip side of what happened under TARP in the 08-09 crisis. This is essentially Washington's attempt at bailing out Main Street. Let's look at it that way. This is going to be the biggest stimulus package in the history of mankind, and they're going to try to get it out within a couple weeks. Think about that for a minute. The scale of this is astronomical. And they decided, because they really didn't have any choice, Congress decided to stuff this program through this little known organization called the SBA that, usually it could expect 50,000 applications a year, in a real busy year, to millions and millions of applications within a couple weeks. And that's the reason why this is being front loaded and being put on the shoulders of lenders and banks in your local community. The way you get access to the PPP is you reach out to your local bank. If it's an SBA lender, that's going to be a little bit easier to and streamline the application process because they're going to be familiar with the process. But the law has been implemented to allow it to be a program in which all FDIC insured institutions, credit unions, and quote, additional lenders, and that list will be to be determined. We haven't seen what that means yet. But the idea here is lenders all over the country can participate in this program and disseminate the funds. It would be an absolute administrative nightmare to even try to audit this program. Perhaps it does get audited. I would say just use the proceeds in good faith. I don't think there's an issue with commingling of funds, but if you're worried about commingling of funds, then just, don't do it. But if you have a good faith application of the proceeds, I mean, the risk of that triggering any problems for you are pretty low, even if there's an audit.
Okay, a few more for you, and then maybe we'll give you a chance to rest your breath for a minute. I'll share some with Jillian and myself. If you pay an independent contractor, would the independent contractor payments be considered payroll in terms of the loan amount calculation? I think I would think that's no, because that's not actual payroll, that's paying another business. But if you have better insight, please can share that.
Yes, I'd say not so fast. It could be an employee payment. So the formalities are important, but not determinative. And what I mean by that, there's a lot of small businesses that'll pay their employees via 1099. Why are they doing it? They're doing it for tax purposes, but are they really employees of the company? Perhaps. And so I think the way to tackle that question is this person that you have in mind a bona fide independent contractor, or are they really an employee? Irrespective of the tax treatment. The SBA is concerned about what it is, not how you treat it for tax purposes, but how do you treat the relationship in your business. So I hopefully that answers it, but it certainly isn't going to break down by tax line. It'll break down by how the relationship works in practice.
And Jillian may have a, go ahead,
Yeah.
Jillian. I was going to say, you may have a comment on what that was.
Jump in. So I think what Ken just said is great advice and probably a good way to look at it if you're looking just at the loan provision. But if you go ahead and make that approach, my concern is that then it could be held against you in other circumstances. And you probably all have heard that, independent contractor misclassification is a really perennially important topic to the DOL, and you can land in FLSA litigation with damages and liquidated damages and penalties for misclassification. So, it may not be worth that risk to use the SBA loan money to pay that independent contractor. Another option would be to convert the contractor to an actual employee, and then you could use the loan money for them. You could probably, it's always a tricky thing to have that conversation, but you could perhaps use, this loan as a reason you're doing it and kind of avoid putting a seed in their mind that they're misclassified. So you could probably get to that place a different way.
Yeah, I was going to say, Jillian, you kindly noted that it does raise other problems if you've been misclassifying someone in terms of that. But here's another question from and Ken, I think this goes to you. But do you have to rehire your staff back for 8 weeks to qualify for the forgiveness during the cover period? In other words, if somebody is terminated or laid off some of their staff or all of their staff, do you have to hire them back for the 8 weeks in order to be able to get it? What if you only hired back half your staff or something? Is that possible to still participate in the PPP?
Oh, absolutely. Yeah, you're not obligated to hiring them back. The downside to that approach, however, is you're not going to get forgiven, right, for those employee expenses that otherwise would be forgiven. The clock is ticking, and if you were to rehire them or restore their salaries before June 30, then that won't be held against you. During that expense period, that 8-week period that follows loan disbursement, will be deemed as if you hadn't laid them off, right? But if you don't rehire them, it just is now a bigger loan on the back end that will be termed out up to 10 years, and then that you'll just have to make the determination. And I'll answer an ancillary question, but it is important. There are cases where an employer wants to rehire their employees, but let's say they're in the food services business and there's servers and front end staff that can't take advantage of their employment because they're on lockdown in the state. They can't even go to work. And so the question that has been raised there is, what do you do if you really actually want to rehire them, but you can't actually send them into work? And I think the guidance there, and again, this is all a grain of salt, and this is not legal advice, but this comes down to the intent, and ideally we'll get more color on this going forward, but it is really about restoring the paychecks of the employees. If you happen to be a restaurateur and you end up paying your employees, but you tell them you don't have to clock in because you can't, that is within the spirit of this program. So that's an ancillary question, but something to keep in mind. I don't think it's going to be a very rigid application where you have to restore things exactly how they were.
So Jillian, there's a couple of ones I think we can take here, both relate to shelter in place. And one person kindly made the comment, shelter in place does not mean you can't go to work. In fact, in healthcare, usually that's deemed an essential business and people are required basically to, well, not required, but people are still allowed to go to work for healthcare entities. And so that's a very good point. If the shelter in place order is related to, it has a healthcare as an essential business, then maybe that's not going to apply, I think, in terms of the reasons and for that person. It would apply to other people maybe, but not to that person. And so they would then not be able to use that as one of the 6 reasons to get the 10 days of sick leave. There was a related question though, Jillian. It says, say you have a stay-at-home orders, stay-at-home orders, do stay-at-home orders fall under the FFCRA and people are owed 10 days of sick leave? And I think, as I understand the question there, in general, if you're not an essential person and you are required to stay at home, from what you're saying, the DOL today clarified, yes, that would be a reason for the 10 days of sick leave. But if you are an essential person and you're exempted in essence from the order, then that might not be a basis for that 10 days of sick leave.
Correct.
So yeah.
Correct. It may, I mean, yes, I think that's right. So if healthcare is an essential function, it depends how the order is written in that state and what it says. So for example, in Minnesota, it's the person in an essential workplace like a healthcare environment. Anybody who can telecommute must telecommute. So that would perhaps preclude the person from qualifying for those benefits if they could telework. And obviously for a lot of healthcare jobs, that's not feasible, but for your back end office jobs, that may well be an option.
Yeah. And so I'm sorry, it's already, time has flown here. It's about 8:20. I think that we will try and get through as many of these questions as we can here. Let's see here. Here's a question I believe that aimed at myself and Jillian. When you talk about using sick leave for the FFCRA, can you explain that again? Do employers use their own PTO? I'm confused about it. We have a stay-at-home order and we're paying employees our full time, but asking them to work some if they can. If you choose not to work, what do we do? So let me, and Jillian, you can jump in here, but first of all, the FFCRA leaves that was effective today as of April 1 for emergency sick leave and emergency family leave. So as of today, let's say that you had an employee whose child's school is closed, right, because of the coronavirus. And so the employee said to you today, or yesterday, hopefully at least a little notice, and said, hey, I'm not going to be able to come into work. I've got a child who there's no one to care for. I need to be at home with that child. Okay, if they say that to you and they are then in essence asking for this FFCRA emergency sick leave and emergency family leave, you can clarify that, but I think that they're asking for that. Under the emergency sick leave, you have 2 weeks. Under the emergency family leave, you have 10 weeks after you have 2 weeks of unpaid leave, but you can combine those together. So you can't force people to take PTO. Even if you have a PTO program, that might you could allow someone to supplement things. So under the both the emergency sick leave and the emergency family leave, the maximum daily payment to an employee is $200 under those leaves. And if you want to, you could allow them to use their PTO to supplement their pay. You're not required to do that. And you're not given a payroll credit if you do that. The payroll credit is only for the amounts allowed for that paid leave, plus the employer portion of health insurance provided to them. So hopefully that helps answer the question a little bit there in terms of things. It was these paid leaves, these emergency paid leaves were effective as of today. And they're going throughout the rest of the year. And so if someone comes to you again for either the sick leave, it's those six reasons, and then for the family leave, it's really just to care for a child who can't be cared for because of the coronavirus.
Yeah, and I agree. That's good
Please.
thoughts, Tim. I'll just say that just to clarify, because the question it involved prior existing PTO, you can't force employees to use their PTO. This has to be a new bucket of leave devoted solely for these 6 reasons.
So Ken, we're going to turn back to you here. When should employees be rehired if a PPP loan is approved? On the date the loan is approved, or what do you do there? If you want to rehire people because now the loan has been approved and you're going to be able to eventually have the loan forgiven, when's the right time to rehire people you've either furloughed or put on or terminated?
I think that's a great question to end on. I would say your business owners, use your discretion. You know the dates and the parameters you have to work with, and just make the best of it.
We've got a few more minutes here, so I'll ask you maybe 1 or 2 more ones. Is it possible that the PPP program will run out of funds and you won't get your loan forgiven?
Absolutely. That's one of the biggest problems with this program on the lender side. I'm doing a lender panel tomorrow, and the audience is largely banks. And there's all sorts of issues on that side of it. It isn't clear exactly how liberal these banks can be with the program. All we know is that the program has been set aside $350 billion by the federal government. It's a massive amount of money, but there's really no visibility on how that's going to be tracked. Theories have been thrown out that the SBA or Treasury have some kind of centralized reporting system that can track the funds that are being dispersed real time, so that everyone can track what's coming from the coffers, so to speak. The complexity on this program, though, is that particular fund will not be depleted until the forgiveness kicks in. So the SBA will guarantee these loans on the front end, but there's no check being cut by the federal government on the front end. The lenders are the ones cutting the checks, and they're relying on the federal government to backstop it. So the depletion of funds, so to speak, will interestingly happen on the back end, and therefore will be no earlier than several months after the first loans have reached the forgiveness period where an application can be submitted. And so there's just a lot of uncertainty around that.
Another question, Ken, if you don't mind, if we apply for a COVID-19 economic injury disaster loan, could this disqualify our ability to get a PPP loan?
No, absolutely not. And what I would say to that question, I'll go further to say, if you can qualify for an economic disaster injury loan, do it. I strongly encourage you to do it because the process is already in place. There's express mechanisms baked into it. If you're comfortable providing a guarantee, if you're comfortable providing collateral, I would encourage you to do it. The one caveat, however, for the disaster loan is you do have to have a showing that you aren't able to obtain credit through other sources. And what does that mean? That's through ordinary channels using, based on reasonable terms. Other credit isn't available to you. So that's one feature that could trip you up. If you happen to have a bank, for example, that has extended a revolving loan to you and you have some availability on that revolver, you have a couple problems there. You probably can't show that you don't have access to other credit. And by the way, I'm almost certain that bank is not going to be thrilled that you're going to lean up your assets in support of an SBA loan. So again, if you can take advantage of it, you don't have those types of restrictions in place already, I highly encourage you to do it. But it is a much more narrow world of companies that can do that.
Ken, you're the popular one here, so I'll give you another question here. Can a PPP be used to pay a physician partner's salary, or are they considered owners and therefore not eligible to be covered by the PPP?
Yeah, that's a great question. It speaks to a lot of organizations out there where you have a partnership structure or some other structure. It really breaks down as it comes down to what is salary, right? The titles and the actual company structures, it's not clear. That's terribly pertinent. The biggest delineation you're going to be seeing is whether someone's an independent contractor or an employee. But for purposes of someone who owns their own business and they are running the business and they have employees, I suspect it should be pretty feasible to determine what the salary is for that particular individual. If they have a structure where they don't take salary, for example, let's say they keep it in the business, they do pay employees, but they have the luxury of not needing to take too much from the company from time to time. That's something that'll have to be factored in when you do the calculation of what that loan is going to look like.
And one or two more quick ones, and then maybe we will probably might have to wrap up here. So real quickly here, Scott, does the PPP loans, do they apply to hourly workers, especially part-time employees? I would think that the answer is yes. It'd be any employee you would be covered.
Yeah, interestingly, the SBA doesn't distinguish on employee status, and this program, it doesn't either. It says any type of status. So it's going to pick up all your full-time, your part-time, or otherwise, and that's legally what it says, otherwise, in the statute. So for purposes of the employee count, for that analysis, whether you have over 500, you pick them all up. And then for purposes of determining the actual payroll costs, you do the same thing.
And then another question here, I rent equipment for an office. Would the equipment rent as opposed to the office space lease also qualify for forgiveness if under a PPP loan amount?
Yes, bona fide rent obligations are going to be permitted uses and forgivable permitted uses. However, those agreements need to be in place before February 15th. On the equipment lease, it gets a little complicated, because some of those look a lot more like a loan than a bona fide lease of personal property. If it is a bona fide purchase money arrangement and not a true lease, you would have to be careful. You wouldn't want to use the proceeds towards paying any principal down. And a customary purchase money arrangement usually has both of those. So that's one you would have to be careful about.
I will take our last question here. I think Scott and Christy and Jennifer. So one of the questions coming in is about what else counts towards calculations of payroll amounts. Do benefit payments like the employer portion of health insurance, or does a 401k match or other benefit payments, do they count towards the calculation of the monthly payroll amount, or is it really just wages that you're counting there or salary you're counting there? Do you know that, Scott? Or I'm sorry, Ken?
Yes, I do, and that's a great question. It's important to keep in mind I spoke earlier about this $100,000 cap on the salary component. Interestingly enough, that only qualifies the salary. So if you're doing the math, you set the salary aside as a separate category and know that if the salary exceeds 100,000, you're not going to get the benefit of anything above and beyond that. There's a separate category for employee benefits, and it's broadly worded, and so it would go on to pick up health and 401k and those other types of benefit type expenses, certainly.
Okay. Christy, Jennifer, Scott, we are hitting 8:30, and I know I could stand for maybe one more question or two, but we've had very patient people listen to us for 90 minutes at the same time.
Thank you so much. I think you guys have done a great job. Thank you, Jillian, Tim, and Ken. This is a huge benefit to the APOS membership. You've answered tons of questions. You've been a huge help for us. So thanks so much, and we'll let you have a break.
Oh, well, thank you to everyone who dialed in. I'm sorry we didn't get to all your questions. We wish we could have gotten to more, but thank you very much for having us.
Thank you so much. Take care.
Thank you.
Good night.
Everybody. Bye-bye.
Safe.
Good night. Bye.
Bye.